Okay, before we head into part two of the market outlook for this weekend, March 12th, this came across my news feed last night. Fed to hold emergency meeting on Monday amid SVB's swift collapse. An emergency closed door meeting, 11:30 a.m., March 13th, 2023. And it is to review or for review and determination by the Board of Governors of the advance and discount rates to be charged by Federal Reserve banks. Also, this is showing up Sunday morning on my newsfeed. Fed and FDIC considering a fund to backstop other banks. Because really, that's what you have to do at this point. This is not backstopping financial markets. This is backstopping the real economy. You had a bank failure, and all the depositors who are uninsured aren't going to have access to their money. And as you've heard by now, hundreds of Silicon Valley companies aren't going to be able to meet payroll. So this is an effect in the real economy. So they are backstopping the real economy. And yes, the financial markets go along for a ride. You can't separate the two. But I'm sure out there there'll be talk about bailing out Wall Street again. This is bailing out Main Street. Although it's Main Street in a nice area of town, Silicon Valley, still, if you don't do something here, this is going to spill over to other banks. If nothing is done Monday before banks open, by Wednesday you can expect another half dozen to a dozen bank failures because all uninsured money is going to run. If you're insured, you think, I'm insured, I'm good. I got $12,000 in my bank account. If the bank goes under, I'm insured, I'm good. You're not going to run to get it out. But if you got $12,000 over the insured limit, you want that $12,000 out. And that will continue on Monday. So something has to be done. As far as SVB, more news keeps coming out, more information that seems to come from credible sources that I've read in other places that I thought, I don't know if I believe this yet. But the more you see it and the more credible the sources are, when you start seeing it in Reuters, Wall Street Journal, Washington Post, you start saying there's something there. SVB was 15 months without a chief risk officer. I'd mentioned this yesterday in part one that what surprised me when I looked at the profile of management was their chief risk officer was brand new, that they had operated for months without one. I didn't know it was 15 months. 15 months. They appointed the new one January 4th of 2023. Person just showed up, right? The CEO, this to me is absolutely shocking. How could you be so stupid? The CEO sold $3.6 million of shares just days before the announcement of the share sale on Wednesday. Just days before. Sold 3.6 million shares, along with the CFO and the CMO. Sold shares days before this. How stupid do you have to be to do something like this? I mean, my God. This one is even more shocking. They paid employee bonuses hours before FDIC seizure. They made sure they had enough money to pay employee bonuses while other companies who needed money to take out to meet payroll didn't get it. But they made sure that they sold their shares and everybody got their bonuses. To say that there isn't absolute mismanagement and pride and ego going on in this bank, I think is an understatement. This is shocking enough that you'd have a bank 16th largest in the U.S. going 15 months without a chief risk officer. Well, look what happened, right? And then you have this going on. Where is chief counsel? They do have a chief counsel. Where is chief counsel at this point saying, whoa, hang on a second. Where's chief counsel over here? Unless chief counsel wanted his bonus as well. It just seems rather shocking. So I think more and more information is going to come out, but I can't see how you avoid the Justice Department not walking in and saying, all right, what's going on here? That somebody somewhere is not going to be charged with something seems rather shocking. So just a word on this. This has to happen. It simply has to happen. And because it has to happen, I think that we can sort of look at Friday as perhaps, a one event day. Late Friday afternoon, that was sort of my thinking, was that, well, look, you can't go through the weekend and open markets on Monday without something. You can't. Because this will be 2008 all over again. So something has to be done, something has to be said. I think it will. I think they'll wait as long as they can. There's probably a couple of interested parties looking at SVB, seeing if they can, have a sale of the company and be done with it. Because I don't think the FDIC really wants to manage a liquidation here. I think they would like to just sell it. They're going to wait as long as they can. If nothing happens, I think you'll get this Monday before the market opens. If not late Sunday night, you'll get an announcement that, hey, listen, nobody has any need to run to any bank. We'll backstop all customer deposits, even above the insurance amount. Don't worry, everyone is okay, to see if that can slow it down. Then you have this going on at 11:30. And I think they chose 11:30 for a particular reason. Get this announced in the morning. Get something announced. See if it calms down the markets. Markets open at 9:30. If by 11:30 it doesn't look like it's working, then the Fed can step in and pull out big guns. But if it looks like it's working, the Fed can come out and say, we're monitoring the situation, we're on top of it, etc. Maybe they don't have to do anything, but I think they chose 11:30 because they probably said, let's do this first. Let's see if this works. If this doesn't work, then we know we need to come out with guns blazing. But if it works, let's not mess up everything we've already done. Well, with that said, let's head on in and look at interest rates and credit spreads, although I don't know that much of that matters at this point, but lots of interesting stuff to look at. Okay, we begin with our par rates as usual. This time, let's just go right to the top line, the cycle high. Look up here all the way out to the 3-year. This is as of the end of Wednesday, and for the 1 month and the 2 month as of the end of Thursday. They all hit their cycle highs. So if we look at the 2-year, on Wednesday close, a yield of 5.05. 48 hours later, Friday close, a yield of 4.6. That is a drop of 45 basis points in 2 days. Most of that coming on Friday. So the week over week, saying, well, we're down 26 basis points on the 2-year week over week, hides sort of what happened underneath. Is that, no, we went from 4.86 to 5.05 in the first 3 days of the week, and then dropped 45 basis points by the end of the week. That is a lot of volatility in yields. So front end of the curve, all pretty much held on to where they are, with the back end of the curve really dropping. So a lot more inversions going on. FOMC is in 10 days. The FOMC is in 10 days, but you have the Fed Board of Governors. That's not the FOMC committee. That's just the Board of Governors. The Board of Governors tomorrow at 11:30. That could, depending on what they say, pretty much negate the Fed meeting. If on Monday they feel that it's necessary to tell the markets that we are on hold, or even a basis point cut, if the fund announcement or whatever they say Monday before the market opens is not enough to placate markets, you could get a cut as early as Monday, in which case the next FOMC would be meaningless. It would just be a meeting for the sake of everybody showing up at the meeting because it's scheduled. Same with CPI, which happens on Tuesday morning, could then become meaningless depending on how Monday goes. So it's kind of hard to start thinking about what's going to happen March 22nd when you first have to get through March 13th. That will set the tone. I would say that 50 basis points is probably off the table, regardless of what CPI says, that it's probably either going to be 25 or 0, that the probabilities, and we see the probability tree down here, that sometime during the week the probabilities will shift to 25 basis points and 0 basis points. I think that 50 is going to disappear. For the inversions, 249 days on the 2 to the 10, 137 on the 3 to the 10. Almost seems that it's not worth counting now, because the event that I said would start everything, that what we should look for, or what will happen, is nothing that we can see coming. You can point out, well, there's trouble over here, there's trouble in the housing market, low quality borrowers are having trouble making their payment. Yeah, but we can see all of that coming. I said it would be something unexpected that comes out of nowhere from someplace you won't expect it. And this is it, 16th largest bank that was considered blue chip before all of this happened. 3-year to 10-month, negative 131 basis points. And the 2-year, 10-year, negative 90. The forward rate, the 3-month rate, 18 months from now minus the current 3-month, 131 basis points. So that is signaling that, because the 3-month is, your shortest term money out there, well, other than the 1 month, the 3-month was negative 74, now 131, is signaling that the market is expecting rate cuts sometime in the next 18 months, 125 to 150 basis points. New York Fed, the effective federal funds rate 4.57, reverse repo up another 2.2 billion at 4.55%. And I'll tell you something, this inversion is not helping that reverse repo. Just to get an idea of the potential problem that we're facing here, and why this tends to be a very good recession signal, because I've been asked this lots of times, is why does it portend a recession? It's because it changes behavior. Look at what you can get on a 6-month right now, 5.17. And the rates, the yields down here, look at the yields are all lower because it's all inverted. Even on a 3-month, you can get 5.01. So let's assume you have 20,000 sitting in your bank account. And what can the bank pay you? Well, they can't pay you 5.17 or 5.01, because if you put money in as a deposit, they now have an asset. If they're going to pay you the same as a treasury rate, where are they going to go? They have to be able to get those rates, and they're not going to do it for free. They're not going to take your money, invest it, and just pass along the money for free, because it's going to cost them money. They can't pay you what a treasury can pay you, because they can't take on the risk. Normally, if you have an upward sloping yield curve and you deposit money, and short money is paying 2%, but long money is paying 4%, they say, okay, that's fine. We'll put the money in 4% and we'll pay you a 2% deposit. We can do better than a treasury. But when you have a yield curve inverted and depositors can get this, but longer term yields are lower, banks, how are you going to pay that? So depositors show up and say, I'd like to take my money out. Well, the more of that happens, you got to start selling those assets. Well, those assets, either the held to maturity or the available for sale, are all underwater. And that's when losses start to get realized. So when you start getting these very deep inversions like this, it becomes hard to hold on to depositor money, because where are you going to put it? So you have to find some place to put it. Now, what you can do is you can take your securities, instead of selling your securities, you can take it to the reverse repo facility and get 4.55%. Well, that's something, which means you can pay your depositor somewhere around 4 to 4.25, let's say. But if they can get upwards of 5% on 3, 4, and 6-month T-bills, why are they going to stick around? I mean, the only time they would stick around is either, it's not worth my time, I don't feel like it, or they simply just can't get T-bills. So something here with this inversion, something is going to break. Something has broken. Unless something is said, it's going to continue on. So I think we're at that cusp in the market right now where we found a place where if we go any further, things are going to get worse. So tomorrow's going to be super interesting. This will be interesting to watch during the week, the Fed Watch tool. Last week, there was a weighting of 71% on 25 basis points. That's now dropped to 60%. It was 31.7% on Thursday. It was 71%, dropped to 31 because most of the weight was on Thursday after Powell on Capitol Hill, and then went from 30 back to 60. And we still have 40% on 50. I expect that to go to zero during the course of the week. Probably by the end of Monday, you'll be almost at 0%. And your decision tree will look like a 0 and a 25. I think is probably what's going to happen. I can't see putting more weight on the 50 when you have that 3-month 10-year inversion going on, and you already have an issue of deposit money leaving banks. That you now have an economic rationale for your money to leave. Look, 5.17 in 6 months. Even if banks use the reverse repo, they're only getting 4.55. They can't possibly pay me 5.17. I'll give my money to the government. June 14th, the 6% is off the table. Last week had 2.1% probability gone, and the weights have shifted down. 5.25. 16.4% probability last week, up to 20.6 now, with 5.5 and 5.75 fairly even. I expect that probably to drop during the course of the week as well. But the big play this week, I think, will be on the Fed watch tool, watching the probability on the 50 disappear. Fed balance sheet, can't leave without mentioning that. Down $1 billion. Down to 7.847 trillion, all in T-bills. This is going to be interesting to see if anything is done there. If nobody picks up SVB, FDIC has to liquidate. Well, we know that in the held to maturity, based on fair value, there's $76 billion in there that has to be sold. If there is more deposits leaving banks across the U.S., then each bank is going to have to probably sell some of its securities to meet the outflow. So there could be a whole bunch of security selling over the course of the week in the MBS and the Treasury market. And if that's the case, the Fed might say, listen, let's just put this on pause for now, because if you already have selling and we have roll off, that's a lot of movement. That may cause some dislocations in the Treasury market. So maybe they might make some announcement about their balance sheet. Monday will be pins and needles from 11:30 onwards. How long is that meeting going to be? What are they going to say? What are they going to announce? When are they going to announce it? What's the outcome going to be? I don't even know that it's worth looking to Wednesday. I mean, even Tuesday morning at this point. CPI seems so far away and so irrelevant at this point. Okay, a lot going on with the Fed funds futures. Let's deal with real yields first. Hardly any move going on here, but if we look at our break-even rates, significantly lower. And this really is just a reflection of the flight to safety. You're not going to stop along the way and say, well, let me think now, the break-even. Should I go into tips? Should I go into nominal? You just want to get your money out of wherever it was, and you want to get it into safety. And that is the Treasury curve. So the break-even rates being lower, I don't know is a collective view of the market, thinking that inflation has been beaten and money is leaving tips to head into Treasuries. I think it's just the flight to safety. However, if this is not handled well, this has the real potential to cause a wider problem that can cause a recession, because if banks fail, well, people lose their jobs. If founders from Silicon Valley Bank can't get their money out in time and can't meet payroll, well, there's going to be layoffs and people are going to lose their jobs, and some of those companies may even disappear altogether. Well, that's a real effect in the real economy. Nothing fixes inflation like a recession. Nothing. That's the fastest way to get rid of it. So the Fed's job may, if they choose to do nothing, their Fed's job may actually be done in terms of rate hikes. But I don't think that they want it to go out that way. The curve, the Fed funds futures curve is super interesting here. What I did was I took a snapshot of it Friday after the close so that you could see the 1 day difference. The gold line is Thursday's settlement. The blue line is Friday's closing, which will be Friday's settlement. So let's just look at it in segments. Last week, the index bottomed at 94.55 across August, September, October, implying a rate of 5.45, which is a target range of 5.25 to 5.5, probably more likely 5.75 in there. As of Thursday night, we still had August, September, October, but at 94.43, which means the implied rate was 12 basis points higher. This is still Thursday night. Friday, never mind August, September, October, we're now bottoming out in July at 94.72, not 94.43. 94.72, so the implied rate is some 30 basis points lower and is bottoming out now in July. So week over week, the implied rate is down 17 basis points. But if I just say it's down 17 basis points, it hides the sheer move that you had just in Friday alone. If we go to the December contract, last week closed at 94.65, implying a rate of 5.35. As of Thursday's close, it was at 94.56, which was putting my December ZQ well underwater. At that point, a rate of 5.44. In 1 day, went from 94.56 to 95.035, a rate of 4.965. That is an implied rate that is almost 50 basis points lower on the December contract. And it hit a high, 95.07 or 0.075 in there, because I closed half of my ZQ position at 95.05. Let's look at the 1 year forward minus the current 1 year, negative 60 basis points versus 51 last week. Nothing to see there. For December 23 to December 2024, 134 basis points lower using 1 month SOFR. That's unchanged week over week. Nothing much to see there. All the action is in what is potentially going to happen over the next little while. TLT had a good week, 3.18%. The big move came Friday, just on Friday alone. SPY down 4.52%. And I've been mentioning for the last little while the overlay I had at the macro level. I was long duration and short beta. And they had a positive correlation that when the market was up, my beta was working against me, but my duration was paying off. And when the market was down, my beta was working for me, but my duration was hurting me. And I said that I was waiting for, the recession event, and when that happens, the correlations will turn negative. And I don't know when it's going to happen. I just know that something somewhere is going to happen at some point. That's the lottery ticket, is the when, not the what. Something's going to happen. You just don't know when it's going to happen. And look at this. Both they turned and had for the day, at least week over week, a negative correlation. So both sides paid off. My long duration paid off. My short beta paid off. So it was a good week last week, with pretty much all of it coming on Thursday and Friday. By the close of day Wednesday, duration was killing me, but beta was doing quite well. So at the portfolio level, it was like, okay, I'm balanced. That was the point. And then Thursday started working, and Friday I won the lottery. It was great. Look at implied volatility. The percentile here, 13-week percentile, 79% versus 37% the week before. So premiums were really high. I closed 50% of my December ZQ position at 95.05, as I explained. I closed my ZB puts. I had 126, 124, and 122 puts. ZB closed at 129. So I closed those because I think, at least I thought in the last couple hours on Friday, that there is no way they're going to allow banks and markets to open Monday without a big solution to this problem, because it was already spilling over to other banks by late Friday. Something's going to happen, and some of this is going to unwind. Probably not all of it, but some of it is going to unwind. So I thought, well, let's grab some of that while it's there. I also closed my April 103 put on TLT for a gain of 71 cents. That's after trading expenses. That puts my average cost on my 60 puts in the low threes, sitting around 320 to 330. With the inflated IV, I sold the January 24 115 calls for 420, and I'm sitting around 320. So worst case scenario, if I do nothing at this point and TLT does not go above 110 by January, worst case scenario, I make about $6,000. Best case scenario, I make the $5 spread plus the $6,000 difference in the price. Best case scenario, $36,000 gain on this trade. Worst case scenario, $6,000 gain. There is no losing on this trade for me at this point. But, we'll see how the market performs. I still think that I can work off the balance of this and get those for free. So if there is a pullback and there's a drop in implied volatility, this 420 will bleed away very quickly. And then I can flip back to reselling the 103 puts at the 71 cents higher. Hopefully, we'll see. I did a lot more on SPY, by the way, and I'll get to that when we talk about SPY. But I did a lot more with beta. So on this screen, you can see that I lowered my duration exposure only because it was such a big move in response to what was going on. And I do think there will be some big answer and some big solution to what's going on, that I was comfortable lowering my duration into the end of the day, because I thought it is inconceivable that you could open on Monday without something. Okay, OAS, not much of a move, but again, this is as of the close of Thursday. Fridays, because it's OTC dealer market, as of all the trades have to be reported to Trace first. We're not going to get these numbers till I think it's 9 o'clock on Monday, or 9:30 on Monday, that we get the result of Friday. But not much to see here. 6-month U.S. Treasury, as we said, 5.17. The 1 year is sitting at 4.9. 1 to 3 year investment grade is 5.66. This is 1 basis point lower week over week. This is 13 basis points lower week over week and 2 basis points higher. So, in looking at the difference in yields, it's not much different than it was last week. So I don't know that there's much to see there. For the mortgage rate, 6.73 as of Thursday's close. Mortgage News Daily had 6.76 as the end of Friday's close. The spread between the 10-year and the 30-year fixed-rate mortgage increased by 23 basis points, though. The 10-year U.S. Treasury was down 15 basis points as of the close of Thursday, while the 30-year fixed-rate mortgage was up 8 basis points. So a spread widening there of 23 basis points. Mortgage applications were up 7.4% for the week ending March 3rd. Refis and purchase index both up. This week we get the NAHB Housing Market Index for March. And on the 16th, you get building permits for February, the preliminary number. The week after, you get the final number, and housing starts for February. And I don't know if anyone's paying any attention to any of this right now, given what we have sitting in front of us. We got to get through Monday. It doesn't seem like anything exists until you get through Monday. And Monday may change the entire landscape such that all of this doesn't matter anymore. DHI, look at that. Week over week up 1.42. In a week where the market was down 4.5%, DHI is up 1.42, outperforming by 6%. Lennar, almost flat, down 0.24%. Mortgage REITs got hit big time. Agency down 7%. Annaly almost down 10%. MBB, which is an ETF for mortgage-backed securities, was up 0.78%. And mortgage REITs got thrown out unfairly with what was going on. The idea that, well, you have these banks that are sitting on the hold to maturity sector, which holds U.S. Treasuries and MBS. And some of the banks that we noted yesterday in part one had exposure to real estate and mortgage-backed securities were experiencing deep sell-offs as well. Mortgage REITs are a little bit different. There are no depositors. There is no run on the fund. They're publicly traded. You want out, you just publicly trade them. What mortgage REITs do, if you've been through the agency video that I put up in the applied series, they use interest rate derivatives to hedge out interest rate risk on both the income statement and the balance sheet, so that as the price of MBS is falling, which it has as interest rates rise, the price of all fixed income securities drop, agency is short U.S. Treasuries, so they recover quite a bit of the loss. The other thing about mortgage REITs is they don't have hold to maturity. Everything is available for sale. The entire balance sheet is fair value at any given time. The entire balance sheet is fair value. So it's not as if they're sitting on some unrealized loss that has not been reflected in equity. They're sitting on unrealized losses, yes, but it's already been reflected in equity because those unrealized losses go to the balance sheet, go to the income statement. So if you look at agency's annual or quarterly report, negative $2 a share. However, that's not the measure of their success. It's their net interest income and dollar roll income, which was near record highs. Yeah, they're going to have losses per share on the income statement once you consider the unrealized loss. But they don't have the issue that the banks have. Neither one of those do. So they just got thrown out indiscriminately. So I did sell puts. I bought shares of agency. I'll explain that a little bit later on what I did. I bought shares directly and I sold puts. And I sold puts on Annaly as well. Okay, let's look at the yen and the peso. You'll recall a while back when I presented these, I said that the peso would probably not perform well in a recession, but the yen would perform well in a recession. And Friday's flight to quality shows the effect that it would have on both the yen and the peso. So here is 8 a.m. on Friday. Here is ZB. You could see the significant flight to safety throughout the day. Here is 8 a.m. on the yen, and you could see the same effect of flight to safety. The yen is definitely a beneficiary. This is the Bank of Japan decision. They decided not to do anything, and you could see the yen immediately weaken. So this strength the next day is really a result of this flight to safety. Here's Powell early in the week, 10 a.m. on Tuesday, released his statement, and of course the yen weakened and continued to weaken. Same with the peso, it weakened, but the peso is strong unless there's a flight to safety. And you can see Thursday afternoon the peso started to weaken, and then that continued in on Friday as well. It did seem like it wanted to strengthen at some point, but it's not going to overcome a flight to safety. It is seen as a risky currency, even though it is being an outperformer for a couple of years now. It's still seen as risky. If money needs to hide somewhere, the peso is just not big enough. It's not big enough to absorb all of those flows. It's going to flow where the currency is large enough and the treasury market is secure enough. And that's not the Mexican government bond market. That is the Bank of Japan. I shouldn't call it the Bank of Japan, but the Japanese bond market and the U.S. Treasury market. So if money is flowing into that, well, you got to buy the currency. It pushes up the price of the currency, which will push the value of other currencies down in relation to it. So if this continues, if this flight to safety continues throughout the week, if the Fed and the FDIC fail to placate markets for the week, you could see the peso weaken even more. You could see the yen strengthen even more, and of course bonds would be well bid because that's where money would go. However, if the market feels that things are going to be fine, I would expect a reversal on ZB. I'd expect the peso to gain strength and the yen to continue on with how it felt Thursday night with the Bank of Japan rate decision. If this continues on and you start to see the peso cross 19, 19.5, head up to 20, at 20 I would be all in on the peso. Most definitely. I was hoping for something to happen that gave me an opportunity to get back into the peso. I did not think we'd see a 17 handle, but we did see a 17 handle down here, 17.9. Same with the week before, there was a 17 handle on it. So week over week, the US dollar lost 0.64% against the yen, but gained 2.92% against the peso. And that is really just a function of elevated risk. Okay, let's introduce the jobs report that we got on Friday, because it really wasn't until SIVB shares were halted that the market really started to fall apart. And it really started to fall apart after it was announced that the FDIC had seized the bank. But on the release at 8:30, futures were negative, turned positive on this news. It actually internally was a pretty good report. It had everything for both sides. Those that thought the economy was strong, here's 311,000 jobs. Those that wanted a lower reading on potential labor force supply constraints and wage pressure, got that as well. Participation rate increased. Average hourly earnings showed only a 2.95% annual increase. Now, this is not wage inflation. Wage inflation is in there, but average hourly earnings captures the mix of workers. However, when we look at the mix of workers, we can't help but say, well, come on, this is actually a pretty good number. So the household data showed an increase of 177 in terms of those that are employed. The establishment data had 311. Average hourly earnings 3301 to 3309. If you take the 1 month percentage and annualize it, you get just a little under 3%. And the Fed is saying that they are looking for anywhere between 3 to 3.5% on wage inflation. And again, this is not wage inflation. Okay, you got the mix of workers in here. But when we look at what the mix included, this is actually very good. Average work week decreased. So with the small increase in average hourly earnings and the decrease in the work week, you actually had a lower weekly earnings number, 1142.15 down to 1141.61. So people are walking home with less money as a combination of slightly more money per hour, but slightly fewer hours. Well, that speaks to aggregate demand. You just lowered aggregate demand by just a little bit because you took away that spending power. Okay, household data, table A4, employment status of the civilian population 25 years and over by educational attainment. This is rather interesting, a hollowing out of the middle, a very barbelled labor force happening here. For less than high school, the number in red is the size that the labor force grew by, and the number in white is the number of people who got a job. So labor force grew by 351 in this category, and for bachelor's degree grew by 286, but shrunk for some college and associate and high school with no college. So either you didn't graduate high school or you graduated university, but if you're in the middle, get lost. 212,000 jobs added in less than high school, 267 for bachelor's degrees, losses in the middle. If you sum all of the jobs, you get to negative 33,000. If you sum the labor force, how the labor force grew, you get to 178. which, line by line, we're told that the numbers don't always add up line by line. I just find that interesting. If we break it down by age and by full-time and part-time, now this is interesting here because you have, we're assuming this of the type of income that these four groups would make. Less than high school would primarily be the lowest hourly earnings, but bachelor's degree and higher would primarily be the higher average hourly earnings. I'm just assuming that, this is the lowest, then you'd get paid more if you had this, you get paid more here, and then finally you get paid the most up here. So being that it's kind of almost evenly split 50-50, it's kind of averages out in the middle, I think. Ages, 16 to 19, only 9,000. Over 20, 169,000, with the 25 plus being 105,000 of that. This is where it becomes really interesting. If we look at the composition of jobs, full-time jobs were up 607,000. Part-time jobs were down 311,000. That's where we get the 300 and something for the establishment survey. So most of these, all of these jobs came from full-time jobs. Part-time jobs decreased by 311. They tend to be lower paying. And full-time increased by 607. They tend to be higher paying. And considering the mix that you have significant amount that are bachelor's degree, a large amount that are less than high school. For average hourly earnings to only be up 2.95% considering the mix, that's pretty good. So that's what the market was excited about when this number came out. Yes, 311 came in hot, but everything else came in nicely, and the participation rate increased by 0.2, which is a big jump. 0.2 increased. We can see it here as well. If we look at the participation rate, 46 over here went to 48.3. You had 72.7 down to 72. Let me see if I can back up some of these circles that I drew over there because I covered my numbers. Let's go. 72.7 down to 72.3. It's 46 up to 48.3. This is 56.4 down to 56. 63.5 to 63.6. It looked like the less than high school did a lot of the heavy lifting here. But the participation rate increasing is good for supply. It increases the amount of supply on the market. The mix of jobs, mostly in the full-time at the expense of part-time, and to only have average hourly earnings up less than 3%, that's good. Those were good numbers. Okay, let's jump right to SPY. See what I did on Friday. Forward four-quarter earnings, 219.46 versus 219.13. This is the first week in quite some time we've actually seen it increase. Not much, 33 cents, but still it's moving in the right direction. Closing SPX 38.6168, which gives us a 17.6 times forward earnings, down from the 18.5, but 17.6. The June ES contracts closed at 39.13, so there's about 41, 42 points of carry in there. My average price is well above that, 41.47. I'm short June ES, 41.47 plus. Well, plus is bigger now because I closed off some parts of my trade. So I'm well in profit on this one. Let's look at the multiple here, 17.6. The inverse of that is 5.68. 1 to 3 year IGs are 5.66. 6-month T-bills are paying 5.17. Still not as exciting as we'd like to see it. I think this gets solved by the 6-month T-bill dropping over time, and that would make the market more attractive in that sense. And if you can get a little bit more of this going on, I don't know now, being that we have some issues in the banking sector, that there might be some downgrades coming and some updated guidance from the banking sector, especially the regionals, that might put a hit to earnings I don't know. We'll have to see. If we're thinking about equilibrium pricing, 16.6 is an equilibrium multiple. 16.6 times our earnings puts us at 36.43. An equilibrium return about 11%, dividend yield of 1.8. So you have 9.2% that you have to make up with price. We got 10 of 12 months left if you want a year-end price, because January, February are done, and I'm not going to quibble over 1 week in March. If you multiply this out, you get the 39.22 year-end target, equilibrium target. Well, we are now at 38.61. We are now actually below the equilibrium year-end price, 39.22 versus 38.61. So it still doesn't get us to a 36.43, but we'll see what happens over the course of the week. Once you get to around 36.43, you are in equilibrium multiple level, 16.6. That would be an interesting purchase at 36.43. Here's what I did this week. I had last week I said I had sold the 4100s and the 4000 calls on ES. Earlier in the week I closed some of the calls. On Friday I closed the balance of the calls. I have no short calls open anymore on ES. And I covered 5% of my ES position. 50% of it is covered with short puts. I sold puts against them, so I just wait for them to expire at this point. There's no extra money to be gained other than just the carry. The time value and the carry to evaporate over time, that's guaranteed income at this point because they're covered. So that only leaves the other 50%. I covered 5% of the total position, so I still have 45% that are still earning, or that could lose if the market recovers, right? I sold the 3790, the 3750, the 3700, and the 3600 puts on ES. I sold those with implied volatility where it is. Look where it is here. The 13-week implied volatility, 97%. So the premiums were really nice. And my thinking was, again, going into the close on Friday, that they're going to have to do something. They're going to. So this is my bet on them doing something. Also, trying to get as beta neutral as possible. I needed something smaller, so instead of ES, I used SPY. I sold the 400s, the 390s, and the 380 puts to try to get as beta neutral as possible. So I lowered my duration. I still have some positive duration, but it's very low. And I raised my beta to be neutral because I am expecting that what we saw on Friday will slightly reverse. So why not take the profit while it's there? Put call ratio on Friday. Look at this, 1.63. That's a big one. Open interest now at 1.97 from 2.05. This is 197 puts for every 100 calls. IV last was 21.7. Last week was 17.1. Big jump in implied volatility. You can see it here in the 13-week that going into Monday before, I don't know if you're even going to have an opportunity. You can do it depending on how comfortable you feel with ES. If you wanted to take advantage of some of that volatility and you felt the same way, thinking, well, they're going to backstop this, they're going to do something to calm down the real economy, because this is a real economy thing, which will help financial markets. So if you think the downside to the S&P 500 is limited, you're not going to have a chance waiting till 9:30 on Monday to sell puts on SPY. That if you do have access to Globex, you might want to consider. Even the 3600s had, I think, over 40 points of premium in there, which would put you below the equilibrium, the current equilibrium price today. Would put you at 35.60 on a break even. And if the market does recover a little bit, market will move up. Obviously, the premiums will drop, but implied volatility will drop, which means the premiums drop almost twice as fast. So the premiums on those puts really melt away fast if you get a risk reversal. You may even want to consider a risk reversal with a 3600 put sold and a 4000 wherever you have to go. If you're getting 42 points, I think on the 36, somewhere around 40 to 42 points, you'd move up as maybe to the 4,000s or 40, 50, and you'd find something that costs 42, and you would buy that. If you're interested in a risk reversal, when the market turns around and implied volatility drops, those things pay off nice, especially when you have a market with elevated skew. There's your put IV, there's your call IV. So your calls are cheap, your puts are expensive, but you're selling the put and you're buying the call. Look what I did over here. I sold puts on a whole bunch of stuff on Friday at multiple strikes throughout the day. Alcoa, GM, Ford, Agency, Annaly, Ares Capital, BHP, Rio, Oxy, Disney, XME, which is the materials sector ETF, XHB, which is housing, ABR, TD, BNS, that's Bank of Nova Scotia, Stellantis, Tesla, yes, I sold puts on Tesla, FCX, Ford, and ChargePoint. I was selling puts on pretty much everything that was on my watch list that I said, well, I'll wait for a nice big sell-off, I'll wait for implied volatility to increase, and these are my targets. So I did them. Ares Capital is an interesting one. It's a closed-end fund, so it has no redemptions. If you want to get out, you sell it. Simple as that. Securitized loans. I didn't sell puts on those. I did synthetics. I did a $20 synthetic and an $18 synthetic. Well, I say and $18. I did at 18 and at 20. So I sold puts on these anywhere from I think the lowest was Tesla, 10 of them, anywhere from 20 up to 500 on some of these, because I'll own them. I don't mind owning them at all. The Canadian banks have nothing to do with what's going on in the US, and if you look back at 2007, 2008, 2009, with American banks imploding all over the place, the Canadian banks skated right through that without an issue, never cut their dividend, everything was fine, they were all absolutely okay. So it was just being thrown out. So yeah, I'm going to sell puts on that. Same with the mortgage REITs. I think that was sort of an overreaction. Same with ABR, overreaction on this one as well. And the others, I've always, I said I'm into the housing stocks. Is DHI on there? No. I had sold puts on DHI earlier. I couldn't get any of the housing stocks because on Thursday and Friday they weren't giving up any ground. I did add XHB though. Yeah, so if on Monday, if I'm right, and there is a big enough announcement on Monday to calm the markets down, you're going to get a rebound on the SPY. You're going to get a rebound, and you're going to get a pullback in duration. That rebound on SPY, with all of the puts that I sold, all of these that I sold, I'm hoping to take significant profit on these Monday or Tuesday. Hopefully Monday, because I don't want to do it if the CPI report is ugly, which honestly I don't think it's going to matter after Monday. I just don't think it's going to matter. So there I sit, and we'll see what happens. By the way, if you have the Applied series, I will be making an announcement soon about some new features. You should notice now for office hours that the last Sunday of every month now has a session. It says it's a 90-minute session, but I usually stay on till it's done. I'll put a video up explaining how you access those sessions, but there'll be a live Q&A session, as I mentioned earlier. We'll start off with once a month. If it's well attended, I'll go to twice a month. If that's well attended, I'll go to once a week. I'm thinking of also doing a live YouTube, probably either on a Saturday or Sunday evening. Sunday evening I think would be great because the market would be open, but doing a live YouTube after you've seen the market outlook, I don't know if that's something that you want, but I would consider doing that. But for the applied series starting in August, I do have something that I will be announcing soon. I want to time it with another announcement, but I will have a fairly big announcement for the applied series. That if you're a subscriber to the applied series, there is I have a new thing I'm going to add in that I think well, I'm going to end up saying what it is if I keep talking, so we're going to stop there because I really want to time it with something else. So there is an announcement coming up for the applied series. And let's leave it here with just a small wrap-up. It is Sunday right now at 10:55 a.m. I've given you the latest information I have based on the Fed meeting tomorrow at 11:30 and the Fed and the FDIC talking about a new potential fund. I think that they're probably in conversations with some buyers this weekend to see if they can't just sell this before Monday open. I think that's really what's going on. We're not going to know anything till late Sunday night, but if there is a buyer, it's going to have to be announced, before the market opens. It's going to have to be announced. If that can't be done, then yeah, I think they're going to come out early Monday morning, probably before 8 o'clock, 7:30, 8 o'clock, and make a big announcement. If not Sunday night, make a big announcement as to their willingness to backstop all deposits at all banks, insured or uninsured. It's the only way to stop money leaving and causing more problems. And then depending on how the market opens on Monday to 11:30, the uglier it is, expect the Fed to come out with guns blazing on Monday after that meeting. But if the market is absorbing everything nicely and everything is back to normal, the Fed may come out with just a message saying we are monitoring things, we're watching things, and we're on top of it. And let's get through Monday, and maybe that CPI number we see on Tuesday might actually mean something. Maybe, but we'll see.